Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
There goes the bell, and the first trade is a little lower than what the Nifty showed us in pre-opening. It's just about 6 points higher, 10,773.
Earnings growth of about 15% is very decent.
You give an advance notice that this share is is going to go, because this surprise element is really short charging the investors.
There is now clear redemption pressure across emerging market ETFs, and that's impacting Indian flows as well.
Positioning has been that this is a market which is, let's mince no word, in the broader market going through a bear phase.
The rupee is a tad weaker because we have a double whammy. It's not just the little bit of strength in the dollar. It's also higher crude strength, which tends to impact us.
0.75% lower on the Nifty. I mean, advanced decline has only gotten worse.
The Midcap index is down 4% for the month. The index is down 4% for the month. And from the top, it's down about some 15% thereabout. Now I think we're getting into that zone.
Weak global cues sink Dalal Street. Sensex sheds over 270 points. Nifty ends below its 50-day moving average. Even mighty stocks like the Bajaj twins, iShares, were not spared. Only 9 Nifty stocks ended in the green.
Midcaps get better. The index loses nearly 300 points. 6 stocks decline for every advancing stock. Adani Enterprises, Adani Power, Reliance Communication and Reliance Infrastructure, some of the worst performing stocks.
The rupee hits a 19-month low but stages a marginal recovery. Strong month-end dollar demand and sustained foreign capital outflows take a toll. However, IT stocks rise or at least outperform in an otherwise downbeat market.
Surge in crude oil prices and the fall in the rupee spook shares of oil marketing companies, supply disruptions, and the attempt by the United States to isolate Iran and, of course, their oil spooks sentiment.
Nifty PSU Bank is the worst performer of the day as far as sector indices go. That index tumbled more than 2% after Reserve Bank's financial stability report warns that bad assets toll will cross the 12% mark by March next year. Well, those were the top 5 headlines from a dreary day on Dalal Street. Hello and welcome to Markets Today Talk Back, the show where we tell you about all the 8 hours of trading in just 5 headlines. I'm Lata Venkatesh with my colleague Prashant Naik. Hi, Prashant.
Hi, Lata. Finally, the range broke, but on the downside, over the next 30 minutes, as Lata pointed out, we will talk about what happened in the market, and we'll tell you the top 5 stories which dominated trading activity today. I mean, I think markets are the biggest headline, and that will take up most of our time. We'll answer your stock-related questions. Joining us now to answer your questions are Deepan Mehta, member of BSE NSE, technical expert Ashwini Gujral. We also have a special discussion with Gautam Sinha Roy, fund manager at Motilal Oswal Asset Management Company. Gentlemen, thanks all of you for being with us here on the show. But before we get our guests in and put some questions to them, let's quickly wrap out the day's events right from the morning. Lata, we didn't wake up to good cues at all. I mean, we actually woke up to pretty bad cues.
Yes, actually. And it was not really Wall Street. Wall Street ended in the green. But Asia just couldn't rise up on its knees. And the pain was most felt in China. The Hong Kong market finally ended almost 600 points lower. And the yuan also took a drubbing. Actually, no, EMs in bits and pieces have been having bad news. Like Erdogan's return in Turkey has not been greeted with a great deal of positivity. The lira has been falling. The South African rand has also been falling. So there are individual pieces of bad news. But as a whole, it appears, and there was a Credit Suisse report to that effect, that developed markets are being preferred by smart money over emerging markets, and we have seen an outflow of about $6 billion from emerging markets. So the overall scenario, including today, has not been in favor of emerging markets. In India, of course, there is an added pain in the mid-cap space. The mid-cap index rose 40%, I think, in 2017, and the small cap index rose 60% in 2017. So there were excesses built up, and now all that is getting wrapped up in a hurry. Somebody was pointing out that China is officially in a bear market because the index has lost 20% this year. I was looking at the mid-cap stocks. 40% are below, are 20% lower on a year-to-date basis. So clearly, while the indices are way away from bear market terrain, 40% of mid-caps in bear market is a bit of a worry, and that seems to have exacerbated selling. But you tell me stock specific. Today, I guess you have a long list.
I mean, just to put out those two indices, mid caps and small caps, where there was maximum pain. 2% lower on the small cap index, mid cap index, similar kind of losses. In terms of pain points, sectorally, PSU banks, energy, real estate, two stocks higher. Actually, only one meaningful gainer, IT. Pharma was barely in the green today. Heavies which lost. I mean, so HPCL, BPCL, IOC topped the list. Actually, GAIL was also a heavy loser. Tata Power, you had names like Ambuja Cement in the banking space, ICICI Bank and BOB both lost. Infra major, L&T was a big loser. Z Entertainment also lost a fair bit of ground. As I said, IT was the only meaningful gainer. So Tech Mahindra, I mean, actually strong gains there. Emphasis and Sign, mid-cap IT did very well as well. They're on your screen. On a day like today, I mean, they really stood out. Long list of losers, I mean, and I think no point looking at individual one or two gainers from the broader market, from the mid caps and small caps, because it was so heavily skewed in favor of declines. The advanced decline told you that. Adani Enterprises, IDBI Bank, look at Jaiprakash Associates, CG Power lost a fair bit. NBCC was down heavily, 8.5%. KRBL was down about 6 1/3. Look at PFC, a small PSU bank, Syndicate Bank. Motilal Oswal was down quite heavily as well. So just to give you an idea of what the kind of damage that stocks suffered in the broader market. Lada.
All right. Well, usually we would be inviting our technical and fundamental experts to ask them where things are headed. We will do that in just a bit. We have a special guest today because it looks like it's a especially bad day for a mid-cap bull. And we will be speaking with Gautam Sinha Roy in a bit. Before that, let us just apprise you of a little more about the market. The second big headline from the markets today, mid-caps getting battered. That index lost nearly 300 points. 6 stocks declined for every advancing stock. And as we told you, Adani Enterprises, Adani Power, Reliance Communication and Reliance Infra were the worst performers. With that backdrop, welcome Gautam Sinha Roy, Fund Manager at Motilal Oswal AMC. First up, Gautam, you know, the markets have remained in that range of 10,700, 10,900. Today, we have broken down. What went specifically wrong today? What's worrying the market?
I think, broader markets, while have been holding for a while, right, at a particular level, 10,800, whatever, but the underlying is very different, Lata, honestly. The sentiment has weakened a lot. If you look at the appetite for mid-caps, both listed as well as the forthcoming IPOs, clearly there are signs that there is a much weaker appetite today than was the case two or 3 months back. Even in the large caps, which are practically holding the market up, we are seeing some sort of flight to safety. Look at consumer stocks, the way they are behaving. Consumer stocks have been expensive for a long time now, and expensive keeps on becoming more expensive. At every level you think, okay, now 60p, wow, that's a lot. Now that 60p has suddenly become 70p. So that clearly shows a flight to safety. The other thing which shows a flight to safety is the fact that people have been buying a lot of IT too. Of course, we do believe that there is some modicum of growth recovery also happening in IT. But typically, getting into IT in a big way also reflects on the market's part a flight to safety. Anyone who is coming into IT without any exposure, well, that could be because there are expectations of better performance going forward from these stocks or from these companies. But people who are already owning IT, adding on to it, increasing their overweight, that's a clear sign of flight to safety. So I think the contours of the market have been one of risk off, of getting into more defensive kind of spaces, and that has continued, and somewhere that had to reflect in the index level also breaking, and that's what probably we are starting to see. Whether that sustains is actually a function of something very different. What it is a function of is clearly the liquidity that keeps coming into the market. While FIs have been selling for a while, what has really sustained the market is the forced buying because of a lot of domestic liquidity coming into markets, right? So that is the crux, and everywhere when people are having discussions on Indian markets globally, People are just asking questions around the domestic liquidity environment, where it could come down to.
You know, that was actually going to be my question as well. As a fund manager, are you seeing domestic money keeping the faith? I think we were okay with inflows up until May. Have the inflows in June been as good as they were in the previous months?
So, Lata, the way to look at it that we discussed last time when we spoke was that now we have a $1 billion of SIP book per month, right? Which one would assume would be quite sticky. You know, it's not absolutely sticky, but it won't come off overnight, right? Even if it comes out, it will take years to come off. So for the time being, that 1 billion gives you a floor to flows, monthly flows. Good part is even now we are seeing net flows over and above that 1 billion. So maybe $500 million, another $500 million of flows this month one could expect over and above that 1 billion. So we are still pretty much in positive territory in terms of flows coming in. The total flows that will come in on a monthly basis will still be 1.5 billion upwards maybe. So flows continue to be supportive, and because of the SIP nature of these flows, one should assume that the flows will not fall off a cliff. The reduction, even if it happens, will happen gradually. So market will find support from that. Market will find support from that, also from the latent money lying in the system. So it's doesn't look like it's falling off the cliff anytime soon.
Okay, so domestic money will be coming in at a steady clip. Gautam, in terms of what you would consider as safe haven picks, what would those be?
Thankfully, right now we're not in that position that we are saddled with cash any longer. Anyways, we don't have a very large SIP book. But yes, the problem of plenty in terms of flows is definitely something that the overall industry has dealt with for a while. What it has reflected really in is higher valuations for good stocks that people have wanted to buy, which means only one thing, which means that prospective returns are going to be lower. And you know, to get decent returns, let's say 15% plus returns after having invested at these levels, you will have to be patient. You have to have a horizon of 3 years, 5 years to get those kind of returns. But this is retail money. Much of it is not tested, you know, first time money. So whether that money is patient enough is a big question that needs to be answered. But as market participants, we need to keep on educating people that, well, you have come in, but better be patient, because that's the only way you're going to get rewarded after having come in.
You know, Gautam, I was looking at the CNX 100, and about 40% of the stocks in the CNX 100 are actually already in bear market terrain. If you look at the year-to-date fall, they've fallen between 20 and 60%. So, do you think value is returning to the mid-cap space?
Yeah, so that's the biggest point of debate in my mind too now. As a category, very difficult to say whether they have become really inexpensive now. I don't think so, honestly. That's my gut sense. While you're right, a few stocks have fallen a lot, but there are reasons for that, right? There are uncertainties around those companies which have been created off late. But what remains true is that any such sharp fall in mid-caps, sustained correction in mid-caps always gives you those opportunities to pick the right mid-caps for the long term. Anyways, mid-cap investing is not never a short-term gain. You know, if you are coming into mid-caps, you better come in for the long term, because only then you make you know, reasonably acceptable returns with the risk that you're taking. So hopefully, with P ratios for mid-caps coming down, we will get to those levels sooner than later. I don't think as a category that has happened. Maybe a few individual stocks, yes, I can think of a couple of NBFC names for that matter, just off the top of my head, which have reached those kind of levels. Maybe a couple of pharma names, you know, but there would be selective names which have reached those kind of levels. But as a pack, not yet, but looks like it will happen sooner than later.
Gautam, on the Nifty itself, do you see bigger falls from here? I mean, inflation seems to be under control, earnings are growing, as last quarter showed us. Will dips be shallow, or do you think we can get back to the 4-digit Nifty levels which we saw, I mean, earlier in March of this year?
Well, we're not very far off, so that possibility remains definitely. It will largely be a function of weakening macros. While you're right that macros are okay, but they have worsened from the past, and we have seen that crude prices have been pretty strong. So I think that the one factor which can lead to a sharp correction is essentially global liquidity, and that would be a function of let's say what Trump does in terms of trade wars, the fear psychosis around that, the way crude behaves, more importantly how global central banks as a collective behave if they start tightening very aggressively this year and simultaneously start raising rates, with something that Urjit Patel called a double whammy, which is actually starting to happen already. So all these factors coming together present a global liquidity risk. So global liquidity is the only issue which could really lead to a sharp correction in Indian markets from here. Domestic liquidity looks like will be supportive in the meanwhile.
Oh, but at least are the odds low of the Nifty going below 10,000?
No, the odds are healthy, closer to 50%.
Oh my God, a good 50% or more are the odds of the Nifty going below 10,000. Now, yes, that's certainly a cautious fund manager. Gautam, thank you very much for joining us. Well, with that, let me invite Ashwini Gujral and Deepan as well. First, Ashwini, to you, your assessment of the damage today, and where does the Nifty go from here?
See, the damage mainly is in the mid-cap space, and now you have any number of reasons. Last year people could not get tired of telling you reasons why to buy, but I think it's basically fund flow which has turned from mid-caps given the increasing rate scenario, etc. So what is clear is that mid-caps will continue to move lower. Now Nifty, Bank Nifty, etc., I think there is enough out there that they will not totally break down, but 10,400, 450 on Nifty and 26,200 thereabouts on the Bank Nifty can easily happen. Now things start to become interesting if 169 is crossed on the currency and crude starts to get above 80 again. Till that happens, I think still we should be range bound, but it's clear that a lot of panic is now setting into the mid caps, and regardless of fundamentals, it's having a bit of a plunge. And I don't think things get sorted out in the next 5 or 6 months, because this sort of uncertainty will only lead to lower prices for smaller stocks. So I don't see the time for value buying across the board yet.
Okay, Ashwini, thanks for that. Stay with us. We will take a very quick break. Deepan Mehta is also going to be joining us when we come back. But as you take that break, hear from Kartika Capital's Teresa Barja, and we'll be back in just a jiffy.
In about 2010, where rural Indian GDP was outpacing urban Indian GDP, those are anomalies. In general, over a long period of time, rural GDP does not or cannot outpace urban GDP. I'm looking for overall growth and productivity in India. I think the building the roads, railroads, getting some of that infrastructure in place will in fact lead to higher productivity in India. We are modestly hopeful that we're seeing signs of investment finally.
Welcome back. You're with us here on Markets Today Talk Back. We've been, of course, telling you what happened in the day today. A pretty bad day if you're a bull, and the mid caps and small caps especially taking it in the chin. You heard from Gautam from Motilal Oswal earlier before we took that break. Ashwini weighed in on the market. We are now joined by Deepan Mehta, member of the BSE and NSE, who's coming in right now as well. Deepan, thank you very much for being with us here. Well, we got through the markets per se, as far as stock markets as in terms of headlines and what happened. Let's get to the third headline of the day, and this is the rupee market. The rupee made a marginal recovery after plunging by almost 30 paise to hit a 19-month low of 68.54 against the USD. Strong month-end dollar demand and sustained foreign capital outflows took a toll on the Indian currency. Meanwhile, IT stocks shine in an otherwise bleak market. Depreciating rupee is a blessing for IT stocks. Nifty IT index ended the day in the green. Tech Mahindra, HCL Tech were some of the top gainers.
Okay, well, with that, let's invite the first questioner on the show. Ramesh Chaube has written to us with a question on Infosys. He says he has 100 shares of the company and has held them for the last 2 years, considers himself a long-term investor. So he's bought at 1,300 rupees. Wants to know whether he should hold or sell. Deepan, you know, today it's one of those few stocks that have not lost much, helped by the rupee. What's your sense? Infosys a safe harbor in these times?
Well, I think we have seen a nice trading bounce in IT companies, and with the rupee depreciating and a lot of positive talk coming from the management, hopefully the next quarter numbers also should be decent. So you have seen that maybe Infosys could see a further up move from here, but I'm not convinced of the medium to long-term prospects of the IT industry and Infosys in particular. The industry is stuck in a slow lane, about 8-9% type of top-line growth, and we find it extremely challenging to grow the margins given the kind of structural changes taking place in the industry. So I think the investor can certainly ride this upswing in Infosys maybe for a quarter or two, but at some point of time he needs to evaluate the holding and look for exiting out of software companies. Maybe once there is a soft quarter or something which may come, maybe September quarter or December quarter, that would be the first signal that one needs to get out of all IT companies, Infosys included.
Okay, fair enough. Get out at a better price. That's the advice to Ramesh Chaube from Deepan Mehta. With that, let's come to the fourth headline of the day. Stocks of oil marketing companies tanked in trade as crude prices surged. Supply disruptions in Libya and Canada, coupled with USA's attempt to stop Iran imports, pushed oil prices higher. HPCL, BPCL and IOC all dropped by more than 6%. Remember, these are big stocks and that's a big fall.
Oh, yeah, absolutely. We've got a question now coming in as well. Nalin P has written in with a question on HPCL. He wants to buy 75 shares of HPCL and wants to know whether he should actually do it. Ashwini, your thoughts on this one? HPCL, good candidate to buy?
In today's situation, you know, probably it can fall more because on one side you have currency, on the other side, you know, you have crude prices. Now, if the government tinkers with any of these companies, then they are going down even further. Maybe they are pricing that in, who knows. So I don't think it's a great idea to buy any quantity of HPCL or BPCL.
Oh, okay. Well, with that, we will have to go to the last headline of the day. When it rains, it pours. The PSU banks were also not spared today in trade. In fact, the Nifty PSU bank was the worst performer of the day after it tumbled more than 2% at index level. Specific stocks, Syndicate Bank, IDBI Bank, Punjab National Bank, all lost significant ground between 6 and 7%, as you can see. And this, of course, perhaps was exacerbated by the Reserve Bank's financial stability report released late yesterday, which warned that bad assets as a ratio of total assets will actually cross the 12% mark by March next year. They stand at 11.6% as of end of last year. So the worst is not over. The tally is only going to increase. Not a very good message for public sector banks.
Oh, yeah. We've got Prakash Singh, who's written in with a question on State Bank of India. He's got 50 shares of the company and has held them for the last 5 days. And he would like his cost, by the way, is about 269 rupees. The stock closed at 261 today. He wants to know what to do. Deepan, you want to take this?
Well, I think that State Bank of India should be sold again at an appropriate time. I think the overall stock market is under corrections. Maybe this may not be the opportune time. But whenever there's a trading rally in PSU banks and positive news flow or otherwise, then one should look at exiting out of State Bank. I think investors should remain focused on the private sector banks, which remain secular growth stories, gaining market share at the expense of PSU banks, and clearly in a very strong position to take advantage of the upswing which we are seeing in the economy. So our preference remains for the private sector banks and not the PSU, State Bank of India included.
Okay, well, thank you very much, Deepan, for joining us with that advice. Preference is for private sector banks and for NBFCs who will be able to take advantage of the area being abdicated by public sector banks. Ashwini, Deepan, thank you very much for joining us. With that, we wind up this edition of Markets Today Talk Back. Thanks for watching.